The Q4 results season just ended, and while most investors focus on what companies did last quarter, we are more interested in what they are planning to do next. So we went through hundreds of management con calls and looked for one thing: managements that are making real, specific, capital-backed bets on their own future. And we found 10 of them. So today in this video, we'll break down these 10 stocks where management is making some of the strongest growth bets we have seen recently. We look at what these companies do, what management is planning, what's driving the opportunity, and whether the numbers support the story or not. Also, a quick question before we start. If you had 1 lakh and could invest in only one of these 10 companies for the next 5 years, which one would you choose? Keep that question in mind as we go through the list, and by the end, tell us your pick in the comments. Okay, now let's get started. Stock number 1 is Apar Industries. And here's the simplest way to think about it. The world needs more electricity, and moving that electricity requires infrastructure. And Apar makes 3 things that sit right at the heart of that infra: conductors that carry electricity across transmission lines, transformer oils that keep power equipment running, and cables that connect everything from factories to data centers to renewable energy projects. Today, Apar has a market cap of over 65,000 crore. The stock is trading around 16,200 rupees. Now, if you look closely, you will see that Apar is one of the very few Indian companies benefiting from 3 mega trends, all at once: power transmission, renewable energy, and data centers. Now, all these 3 trends are growing, and all 3 need what Apar makes. And the numbers already show it. In FY26, conductor revenue crossed 12,700 crore, annual order inflows hit 11,450 crore, and the order book stands at 7,671 crore. Over the last 5 years, Apar has grown revenue from 6,400 crore to around 22,900 crore. That's a CAGR of roughly 29%, and that shows they have been executing. Now let's talk about where they are going. Management is targeting nearly 25% annual growth in cables alone, and to back that up, Apar is investing around 850 crore in cable capacity this year, with a 10,000 crore cable revenue target firmly on the table. And for FY27, the total capex plan is around 1,500 crore. That's more than double what they spent in FY26. So why the jump? Because management believes India's data center industry is set to attract around 1.7 to 2.1 lakh crore in investments by 2030, with installed capacity expected to grow to over 4,500 megawatts. India is also offering a 20-year tax holiday for eligible foreign companies using local data center infra, which is only going to pull in more global capital. But yes, there are risks too. Right now, some customers are holding back on orders because aluminium prices and logistics costs have turned volatile. That's a real short-term headwind. But if you're thinking 3 to 5 years, the picture looks very different. Now let's look at stock number 2, Garware Hi-Tech Films. So the market is valuing Garware as a specialty films manufacturer, and the management is spending money like it's building a global consumer brand. That gap is exactly what makes this company worth understanding. Think about it. Whether it's the sun control film on a car window, a paint protection film on a luxury vehicle, or specialty films used in buildings, Garware operates in a niche where technology, branding, and distribution matter far more than just scale. Market cap is around 15,700 crore, and the stock is trading near 6,770 rupees. Now, for years, Garware was essentially B2B, selling films through distributors and large customers. But management is now trying to go directly to the end consumer. And why does that matter? Because selling directly to the end customer can generate 25 to 30% higher margins compared to distributor-led sales. To make that happen, Garware is expanding its application studios, building Garware Home Solutions, onboarding automotive OEMs, and investing in digital marketing, all to make it a visible consumer brand, not just a manufacturing supplier. And here's the impressive part. FY26 was disrupted heavily by US tariff uncertainty, yet the company posted its highest ever profit, with PAT hitting 338 crore. For FY27, management is guiding for at least 2,500 crore in revenue, that's about 20% growth. The risk here is the transition itself. If consumer adoption is slower than expected, revenue may still grow, but the valuation re-rating many investors are hoping for could take much longer. Now let's look at stock number 3, which is Senores Pharmaceuticals. It's not just a pharma manufacturer, it's trying to control the entire value chain, from product development to manufacturing to commercialization to distribution. Let me give you one number. In FY26, Senores reported 664 crore of revenue, and management is openly targeting a US business alone worth 2,500 to 3,000 crore over the next 3 years to 4 years. That's almost 4 times its current consolidated revenue. The company today has a market cap of around 6,000 crore and the stock is trading near 1300 rupees. So how are they planning to get there? Over the last year, they have gone from 22 ANDA approvals to 51. An ANDA basically is a regulatory approval that allows a company to sell a generic drug in the US. Of those 51, only 20 have been commercialized so far. So another 30 approved products are waiting to be launched over the coming quarters. That looks like a loaded pipeline. The company is growing its US presence through acquisitions, a US FDA approved facility, and a new entry into the US government healthcare market. And government and defense contracts in pharma tend to be sticky because of fewer competitors, better visibility, and longer relationships. Management's guidance for FY27 is 30 to 40% revenue growth and 50 to 60% PAT growth. The risk here is pharma companies routinely get approvals months or even years before they generate meaningful revenue from them. So the real test here is execution. Now let's move on to stock number 4, Syrma SGS Technology. And this one is playing a very long game. Every EV, every smart meter, every medical device, every railway signaling system, every data center server, they all need electronics inside them. Syrma has built its presence across exactly those segments. Their customer list includes Bosch, HUL, Eureka Forbes, and AO Smith. At 1300 rupees per share, Syrma is valued at nearly 26,000 crore. FY26 revenue came in at 4,857 crore with PAT of around 346 crore. But the real story is this. Management is trying to build one of India's most integrated electronics manufacturing platforms. Historically, Syrma assembled electronics. Now they are moving up the value chain into design-led manufacturing, exports, defense electronics, and something particularly important, PCB manufacturing. A PCB or printed circuit board is literally the foundation of every electronic device. India currently imports more than 80,000 crore worth of PCBs annually, with domestic production meeting only a small fraction of that demand. Syrma is entering this space through a joint venture with a South Korean company with 1600 crore planned for investment. Commercial operations are expected by FY27. If that works, Syrma goes from assembling electronics to manufacturing one of the most critical components inside them. That's a meaningful step up. They are also moving into defense and maritime electronics through the Elcom acquisition and building high reliability electronics through a partnership with Elimaster. The risk to watch here is nearly 83% of Syrma's revenues come from consumer, industrial, and automotive segments. Any slowdown in those markets can temporarily hit order flows. Now let's move on to stock number 5, AXISCADES Technologies. And this one requires a bit of context to really appreciate it. For nearly 2 decades, AXISCADES built deep engineering and design relationships with global aerospace and defense companies. They helped these companies design complex, critical products. That gave them credibility, technical depth, and access. Now, management is using all of that to make a much bigger move. The company is moving away from some of its older businesses and investing more in aerospace, defense, AI-driven electronics, and space technology, basically where growth opportunities are bigger and customer relationships tend to last longer. To fund this shift, the company plans to raise over 2200 crore by selling some of its existing businesses. The stock is trading around 1900 rupees. Market cap is close to around 8300 crore rupees. Now, management is targeting 9000 crore in revenue and 960 crore in profit by FY30. This growth is expected to come from defense, aerospace, data centers, and semiconductor systems. FY26 was about building the foundation, and FY27 is when the company plans to start executing on these growth plans. Now let's move on to the next stock on the list, which is Epack Prefab Technologies. The company makes prefabricated building solutions, basically pre-engineered steel structures, sandwich panels, modular systems that cut construction time significantly because everything is manufactured in a factory and assembled on site. Their customers come from renewable energy, logistics, manufacturing, power infra, and data centers. Market cap is around 2,707 crore and the stock is trading around 269 rupees. FY26 was a strong year. Revenue grew 34.5% to 1,500 crore. Profit after tax jumped 56% to 92.6 crore rupees. And they ended the year with an order book of around 1,100 crore. For FY27, management is guiding for around 30% growth in the prefab business, which means revenues of roughly 1,950 crore. What's interesting is the mix of the order book. 36% of current orders come from renewables, data centers, semiconductors, and logistics. All of these are high growth sectors. To support this, Epack is expanding capacity across Gujarat, Ghiloth, and Mumbattu. The risk to watch here is their sandwich panel facility, which is a newer high value product line, operated at only around 25% utilization last year. If that ramps up slowly, it could weigh on the returns from their expansion investment. Now let's move on to stock number 7, Acutaas Chemicals. With a market cap around 26,500 crore, the stock is trading near 3,246 rupees. The company operates across 4 segments: pharma intermediates, semiconductor chemicals, battery chemicals, and commodity chemicals. Pharma intermediates are the biggest revenue driver today, but management is steadily adding new engines. They serve customers across 55 plus countries, with manufacturing in Gujarat, Uttar Pradesh, and South Korea through a joint venture. FY26 was strong. Revenue grew 33% to 13,400 crore. PAT hit around 356 crore, which is the highest in the company's history. For FY27, management is guiding another 25% revenue growth. What's powering the next phase? Two things. Battery chemicals are expected to contribute meaningfully as the company scales that vertical and launches new products. And semiconductor chemicals are expected to benefit from their IndiChem joint venture in South Korea, which is a market where India has barely scratched the surface. The risk here is classic deep growth company risk. A large part of the story depends on scaling businesses that are still in the investment phase. Now let's move on to stock number 8 on the list, Yasho Industries. It's basically a specialty chemicals manufacturer that supplies high performance ingredients to both industrial and consumer applications. They have over 140 products, customers in more than 50 countries, and a strong export focus. Market cap is around 3,470 crore and the stock is trading near 2,879 rupees. Now let's look at the numbers. FY26 revenue grew 22.7% to 830 crore in what was actually a tough year for specialty chemicals broadly. The company also generated 153 crore of positive operating cash flows and improved its debt to EBITDA ratio from 4.7 to 3.75. Now here's what management is targeting going forward. Plant utilization was around 60% last year. Management wants to take that above 75% in FY27. That jump in utilization alone can drive meaningful EBITDA margin expansion without needing heavy incremental capex. The longer term target is 1500 crore in revenue by FY28 with EBITDA margins above 20%. Now this is being supported by a long-term customer-funded project from a global MNC which is expected to start contributing from FY28. The risk here is straightforward. A large part of the margin and growth story depends on utilization actually going up. If that is slower, margins may take more time to expand. Now let's move on to stock number 9, Beta Drugs. This is a niche oncology-focused pharma company that's doing several things at once. Branded oncology formulations, contract manufacturing, API production, exports, and dermatology through a brand called Nivian. They also operate one of India's largest oncology-focused CDMO businesses, which is supplying to several leading pharma companies. Market cap is around 2,000 crore. Stock is trading near 1,990 rupees. FY26 revenue was around 396 crore, which is up from 368 crore the year before. The branded oncology segment contributed 140 crore, CDMO 149 crore, exports 71 crore, and APIs around 25 crore. Now here's what management is betting on. The company's oncology business is expected to grow 20 to 25% every year for the next 3 to 4 years. To support this growth, management plans to launch 20 to 25 new products and expand its presence across hospitals and cancer treatment centers. Exports are also a key focus here. The company has already filed over 200 product registrations globally and expects around 100 new approvals in FY27. Exports currently contribute 18% of revenue and management wants to increase that to 30% by FY30. Overall, under its Vision 2030 plan, the company is targeting 900 crore in revenue within the next 4 years, driven by growth in oncology, exports, IVF, and dermatology. Now, there is one thing worth noting here. FY26 export revenue was impacted because tenders worth 20 to 25 crore got pushed into FY27. Any future delays in registrations or approvals could affect the pace of execution. This is a business where patience matters a lot. Now let's look at the last stock on this list, Sakar Healthcare. This is another oncology story but with a very specific angle. Sakar has spent the last few years building an integrated oncology platform, APIs, finished formulations, R&D, and EU GMP compliant manufacturing facilities. They manufacture products for companies like Zydus, Intas, Torrent, Emcure, Glenmark, Cipla, and Abbott. Market cap is around 1800 crore and the stock is trading near 804 rupees. Now let's look at the numbers. In FY26, revenue grew from 50 crore to 71 crore and profit after tax doubled from around 5.7 crore to 11 crore. Oncology jumped from 21% of total revenue to 38%, which is a strategic shift management is deliberately pushing for. Management now aims to cross 300 product approvals and secure over 100 international business contracts in the next 2 years. With over 250 dossiers already filed globally and partnerships with companies like Accord, Acutaas, and AXISCADES, the next step is converting approvals into revenue growth. The risk here is that this is a classic pipeline conversion story. A lot of the growth is still ahead of the dossier stage. How fast those convert will determine the growth. So these were the 10 companies, all different industries, all different stages, but one thing in common. Management teams that are making real, specific, capital-backed bets on their own future. Now, management guidance isn't a guarantee. We've seen that movie before. What matters is whether these companies actually execute on what they've said. Some of them will, some will take longer. And that's exactly why tracking management commentary, not just quarterly numbers, is one of the most underrated edges an investor can have. And do you want us to cover this regularly? If yes, tell us in the comments. We read every single one of them. If you found this useful, subscribe because we keep doing exactly these kind of deep dives so you don't have to. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.